Do you believe the shift in car market dynamics is an opportunity or a potential pitfall for consumers? Car buyers have certainly navigated challenging waters, grappling with skyrocketing prices and a notable car shortage. However, the tides appear to be changing. Industry experts, fortified by data from Cox Automotive, forecast a significant change by this fall. The once barren car lots are now overflowing with vehicles, many of which will likely see substantial price cuts in order to be sold by the end of 2023. If you've been holding off on a car purchase, eagerly anticipating a price reduction, you're in for a treat. We have fresh updates on which brands are slated for the most significant markdowns, savvy strategies to maximize your savings on an upcoming purchase, and an in-depth analysis of the ongoing tumult in the car market. But before we delve deep, please show your support by giving this video a thumbs up. Your encouragement means the world to us. The car market in 2023 has been nothing short of a roller coaster ride. At the start of the year, the sticker shock was real as new car prices skyrocketed, crossing the staggering $50,000 mark. Conversely, the used car segment provided a sigh of relief, registering its steepest price decline since the onset of the pandemic. But if you thought those fluctuations were dramatic, the subsequent months took the market by storm. Merely 9 months post their zenith, new car prices have taken a downturn, shaving off a substantial $2,200. Analysts now project the average new car price to hover around $45,000 as we usher in December. And for those eyeing the pre-owned market, there's more good news. Wholesale prices of used cars are anticipated to nosedive by an astonishing 31% in the final quarter, according to projections by J.P. Morgan. This translates to a potential retail savings of around $8,000 compared to 2022 prices. With such profound shifts underway, the ultimate question remains: will you capitalize on these market dynamics or exercise caution? Mike Jackson of AutoNation warns we might be nearing the worst car market crash since 2008. Selling cars is becoming more challenging, indicating the car industry's impending slump. The car market ballooned due to a supply-demand mismatch. Prices surged by about 40% from 2021 to 2022. But there's a limit to what consumers can spend on cars. We're witnessing the start of a decline, mirroring the real estate sector. The root cause: too many cars and dwindling demand, accentuated by steep interest rates, says senior economist Jonathan Smoke. Prices will stabilize and sales might decrease for 2023's latter part. We're reaching a phase where the market finds its equilibrium, resulting in stable sales and fewer price surge stories, concludes Smoke. Prices in the used car market are consistently dropping. Recent data shows a significant decrease in the wholesale prices dealers pay for vehicles. This historic decline was revealed by the Manheim Used Vehicle Value Index, part of Cox Automotive, Kelley Blue Book's parent company. The stats show an 11.1% reduction in prices dealers pay for used cars, the most substantial monthly drop since March 2008 and one of the largest in U.S. history. Typically, when wholesale prices decrease, retail prices follow suit in about 6 to 8 weeks. Although it took longer for these price drops to be seen on car lots this year, they're now evident. The average car installment has decreased by $109 since the start of the year. Experts point out these drops would be more evident if not for the current high interest rates. Supply chain disruptions are lessening, meaning more cars are available at dealerships, but the demand is plateauing due to increasing rates. J.P. Morgan analysts suggest that by the end of 2023, wholesale used car prices might plummet by 31.2%. There was a 9.3% decline from January to May. From June to July, this decline rate tripled, and a further 10.8% drop is anticipated by the fourth quarter. New cars aren't exempt either, with up to a 10% depreciation expected this year, leading to a predicted 7% adjustment in the upcoming months. Analysts project that 2024 might see an even sharper downturn. Different vehicle segments will experience price reductions variably. Some vehicles' values might halve, while popular ones will see milder reductions. For instance, in July, sports cars had a 2.6% dip, pickups 6.5%, and compact sedans 15%. Cox Automotive identified brands currently overstocked, meaning imminent price cuts to clear stock. Brands like Ram, Dodge, and Chrysler have twice their ideal stock. Similarly, Lincoln, Buick, Infiniti, and Jeep, along with Ford, Mini, Audi, and Genesis, have an excess. However, most of this surplus is in high-end models. Clark Howard, a financial expert, noted an evident inventory buildup for all except Honda and Toyota dealerships, with prices soon to impact cheaper models. For prospective car buyers, some tips could save significant amounts. Brian Moody from Kelley Blue Book recommends domestic brands as the best pick currently. While brands like Volkswagen and BMW remain pricier than before, some of their rivals have moderated their prices. Options like General Motors, Hyundai, Mazda, or Buick could be more budget-friendly. For example, Buicks are now selling at about 3% below MSRP. Zach Crowley, a car industry analyst, concurs, emphasizing that domestic brands have effectively increased their stocks, providing more choice compared to import brands. Vehicle deals are more available for models with less demand or in regions where they aren't top sellers, Cruella noted. Howard Clark advises a similar strategy. Expanding your search beyond the local market can yield significant savings. If you can delay a purchase, Clark suggests waiting until automakers and dealers adjust their strategies. Certain vehicles, including pickup trucks, minivans, convertibles, and coupes, have seen significant price reductions as of August 21st, according to Carl Brower from iSeeCars.com. These segments will likely normalize in pricing first, followed by high-demand SUVs. Brower points out that pickups, despite their popularity, are seeing softer prices due to poor fuel economy in an environment of rising gas prices. As for coupes and convertibles, consumers tend to shy away from these during economic uncertainties. Brian Moody adds, if you're seeking savings, avoid what everyone else is after. Dealerships for a while focused on selling high-end vehicles with additional features, driving up the average vehicle cost since 2020. With approximately 2 million unsold vehicles currently, Clark notes that dealers are now providing significant discounts. Gone are the days of added fees. Dealers are reverting to traditional discount strategies. Clark believes automakers need to cater to market demands, which currently lean towards more affordable vehicles. Though conditions are improving for buyers, Clark mentions that we haven't reached the market's bottom yet, but expects better prices in the latter half of 2023. The surge in interest rates has impacted buyers' ability to manage car debt, suppressing demand. When supply is high and demand dwindles, prices drop. While this drop is expected after the recent pricing bubble, it poses a challenge for automakers and dealers. The upcoming market crash, though unpredictable, will impact the auto industry deeply. This is compounded by shifting consumer preferences towards electric vehicles. As the industry undergoes rapid changes with electric vehicles gaining market share, surviving the downturn will necessitate a different approach. While maintaining strong fundamentals is crucial, adaptation to a changing market and prioritizing growth will be key to weathering the storm. Companies risk being overwhelmed by debt and may still need to cut prices to drive sales in the near future. The car industry's challenge doesn't end with navigating the downturn, but preparing for the post-downturn phase. The horizon appears uncertain. While short-term price drops benefit consumers, they spell potential disaster for automakers and dealerships. We invite your insights on this topic and appreciate your engagement.